What if I told you that by taking Social Security too early could skyrocket your tax bill in retirement, even if you think you're in a low tax bracket now? It happens because of something called the Social Security Tax Torpedo. And if you have a majority of your retirement savings in pre-tax accounts, like a 401k or IRA, or you're expecting a pension, you could be facing this common tax trap retirees face. So in this video, I'll break down how the tax torpedo works, how it could push you into a higher tax bracket, and most importantly, how to avoid it. I'm Christian Class, and I'm the co-founder of 402 Financial, and I created this channel to help you make the most out of your retirement. First, we need to understand how Social Security benefits are actually taxed. Social Security is taxed based on what's called provisional income. And depending on what your provisional income is, anywhere between 0% to 85%, your Social Security benefit is included in your taxable income. So how do we calculate this? Well, in short, we add your adjusted gross income plus any tax-exempt interest, think like income from municipal bonds, plus 50% of your Social Security benefits. Then, once your provisional income is calculated, you can apply it to these income tables to see what percentage of your Social Security benefits, if any, will become taxable. Once you cross these income thresholds, the Social Security tax torpedo can hit, causing you to pay far more in taxes than you expected. So as your income rises, your income is not just moving you into a higher tax bracket, but you're also pulling more of your Social Security benefits into taxation as well. And this creates a compounding effect that increases your marginal tax rate. So if you're already in the highest range where up to 85% of your Social Security benefits becomes taxable, even a small increase in income can have a big impact. For example, if you withdrew just $1 from your IRA over these threshold limits, you're not just adding $1 to your taxable income, you're also triggering an additional 85 cents from your Social Security benefits to become taxable. So instead of being taxed on just $1, you're effectively being taxed on $1.85 for every dollar you withdraw over these limits. And this is where the tax torpedo is so dangerous, because it sneaks up on retirees and can drastically increase their tax burden without them realizing it until it's too late. Now, you'll begin to see this tax torpedo affect the marginal tax bracket. When you're in retirement, your bracket looks much different than normal income brackets once you start taking Social Security. Here's the effect in retirement if 85% of your Social Security benefit becomes taxable. Your marginal tax rate of 10% becomes 18.5%, and 12% becomes 22.2%, and so on until the effect of this tax torpedo falls off to normal marginal rates. And it only falls off once 85% of your Social Security benefits becomes taxable. And that's why you don't see the effect in the higher tax bracket. So I threw a lot at you, so let me show you a real-world example of how this may work. Let's assume a married couple, Art and Mallory, who are both 67 years old, had the following retirement income. Art has the Social Security benefit of $2,100 per month, and Mallory has a benefit of $1,700 per month. So in total, they have $3,800 in gross monthly Social Security benefits coming in each month. Plus, they have portfolio distributions from their IRA equaling $2,250 per month. So if we do the math here, every year there's a total of $27,000 in IRA distributions and $45,600 in Social Security benefits each year. And when we run these numbers through a taxable benefit calculator, because there's only $27,000 in IRA distributions, their Social Security benefits, $45,600, has a taxable amount of only $10,930. So their adjusted gross income from IRA distributions plus the taxable amount of Social Security is a total of $37,930. When we use the 2025 standard deduction for married filing jointly, which is $33,200, which is a little higher than the standard 30 because they're over 65. This gives them a taxable income of $4,370. And when you run that through the federal tax brackets, this gives them a tax liability of $437. Now let's change this up slightly and assume Art and Mallory want to do a home renovation. They need to take an extra $36,000 from their IRA. How does this change things for them tax-wise? Well, when we run the numbers, you might be surprised. So just like before, we have the $27,000 in IRA distributions, but we're going to add that extra $36,000 for the home renovation. Again, the Social Security benefits stay the same. So when we do the tax calculation on this, we get a much higher tax bill. In this example, we have $63,000 of IRA distributions. But now, instead of the taxable amount of their Social Security benefits being $10,930, it's increased to $38,760. Now their AGI is now $101,760, and this means their taxable income is $68,560 after the standard deduction, which causes their tax liability to skyrocket from $437 to $7,750. So how did taking out $36,000 from their IRA result in their taxable income increasing by over $65,000? And this is all because as your income or distributions increase over these income thresholds, a larger portion of your Social Security benefit becomes taxable. So in this example, that extra $35,000 in IRA distribution causes over an additional $27,830 their Social Security benefits to be counted as taxable income. So as you can see, for every dollar this couple pulled out of their IRA, their taxable income increased by $1.85. This is the Social Security Tax Torpedo in full effect. And real quick, if you're finding this video helpful so far, make sure to hit that like button. It really helps more people see this information. And if you're asking yourself, do I have enough to retire? Use the link in the description to take the quiz to find out. Now, this tax trap can be avoidable, and much of it depends on type of retirement income, the types of accounts you have, and the amount of income you're going to need while you're in retirement. Because you can plan around this to either mitigate or lessen the effect. But from a high level, here are a few ways that may help you lower the effect of the Social Security Tax Torpedo. The first thing you could do if you have some time before retirement is consider setting up and using a Roth IRA. This might just be the smartest thing you could do to plan for taxes on your Social Security. Because withdrawals from a Roth account, they're not counted in your provisional income. So if you think you might go over these income thresholds, you may want to consider building up a part of your retirement savings into a Roth account. And for 2025, you can put away $7,000 in a Roth IRA, and if you're over 50, you can do $8,000 for the year. And for those whose income is too high to set up a Roth IRA, you may want to consider seeing if your employer offers Roth contributions into your 401k. And this would allow you to contribute anywhere between $23,500 to up to $34,750 per year, depending on your age. Now, if you want greater detail on the contribution limits for each account, or to see if your income is too high to contribute to a Roth IRA, click the video up above after this. Now, it may require some planning to see if this makes sense, but you could take advantage of a Roth conversion, whether in a workplace plan, if that's allowed, or into an IRA as well. Just be careful because you need to realize there's a cost to these Roth conversions, because any amount you decide to convert will count as taxable income for the year you did them. And if you're 63 or above, you got to be careful with the conversion because you don't want to face an IRMA Medicare premium increase. Now, this doesn't mean you shouldn't do a Roth conversion. Just understand what you're getting into before you make the decision and talk with a professional. Now, those are helpful if you're already working, but what can you do if you're already retired? The first way to minimize the tax torpedo is to consider strategically spending down your pre-tax accounts while delaying Social Security. By tapping into your IRA or 401k first, you're not only spreading out your taxable income over time, but you will also allow your Social Security benefit to grow. Plus, the strategy can help reduce the size of your required minimum distributions, which are often what pushes retirees over that income threshold that triggers higher Social Security taxation. The second option you could consider is if you're 70 and a half and you're charitably inclined, you don't need all your retirement account distributions, you may want to consider using qualified charitable distributions or QCDs. This allows you to donate up to $105,000 per year directly from your pre-tax retirement accounts to a qualified charity. What's the key benefit here? The donated amount doesn't count towards your provisional income, meaning it won't contribute to the taxation of your Social Security. Plus, it helps lower your RMDs reducing future taxable income. The third option to keep in mind is the use of asset location. Simply put, where you hold different types of investments can impact how much of your Social Security is taxed. Since interest from bonds create taxable income, even if you don't need the income, it can be beneficial to hold bonds in a taxable deferred account like an IRA or a 401k. And in your taxable account, you hold stocks that allow you to recognize income only when you want to. So by strategically placing investments in the right accounts, you can help minimize the impact of the tax torpedo and keep more of your Social Security benefits tax-free. Finally, if you have losses in your brokerage account, you can take advantage of tax loss harvesting. This involves selling investments at a loss to offset gains and even reduce your ordinary income by up to $3,000 per year. And if you're right on the edge of that tax torpedo threshold, this strategy could help keep you below it and avoid unnecessary taxes. Here's the truth though, sometimes you just can't avoid the tax torpedo. Whether it's high RMDs, a pension, or other forced income like dividends or interest, it might be unavoidable. The point of this video is just because you could face the tax torpedo doesn't mean you should stop spending money or enjoying your life just to avoid taxes. The key is to having a plan in place to reduce the impact where you can. So if you can spend more and pay less in taxes, that's a win in anyone's book. Well, except for the IRS. But here's the thing, everyone's situation is different, and what works for one person or couple might not work for another. That's why I created the How Much to Retire quiz. It's a quick and easy way to see where you stand and if you're on the right track to retire. Click the link in the description and don't forget to like and subscribe. Thanks for watching, and I'll see you in the next video.